Is it true that your dividend growth portfolio truly explodes once it surpasses that $100,000 in value mark? And if that is the case, why exactly does that happen and how does it happen? Now in this video, I'm going to show you my actual dividend growth portfolio as you see right here on the screen and explain to you why, in fact, I do think why the snowball effect really starts to take place and why your portfolio explodes after $100,000 invested. Now, if this interests you at all, make sure to please drop a like down below, subscribe, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now, as of recently, more than ever maybe, I've been seeing more and more people online criticize dividend growth investing, saying that it's a waste of time and that it's not worth buying into different dividend paying stocks or ETFs, considering they're only going to pay you a few cents per share per quarter most likely. And my response to them would be simple. At first, when you're building out a long-term dividend paying portfolio, whether you're investing into low yielding, higher growth potential, or of course higher yielding stocks and ETFs, you are going to have a portfolio and be faced with the reality that this portfolio is only going to pay you most likely a few dollars on a monthly basis, if even that. But over time, as the portfolio gets larger and larger, and after you hit certain milestones like we're going to talk about in today's video, the portfolio is truly going to have a life of its own. So much so to the point that I believe if an investor stays invested long enough and stays the path, they are going to get paid so much in dividends every single month on average that they are not even going to know what to do with the money. Now, like I said a second ago, this is every position I have throughout my multiple different dividend growth portfolios. Keep in mind there might be some positions that have not been updated as of filming this video, but more or less this is pretty much what I'm working with throughout my portfolios. Now, this portfolio was of course not built overnight, and I'm currently going on 6 or 7 years now investing very substantially, putting every single dollar into different dividend paying stocks and ETFs to build a portfolio of this size. Now in this portfolio, there's different holdings like, for example, 1,000 shares of Apple. We even have things like 2,818 shares of ticker symbol O Realty Income. And my overall strategy when it comes to investing in the stock market over the past several years has been pretty simple. I want to invest in different dividend paying stocks and ETFs that have the potential to grow in share price over time, but also every single position in this portfolio also pays a dividend on a monthly or quarterly basis. Now, this is personally my strategy because I'm looking to use these dividends within maybe the next 5 or so years to hopefully help pay for some of the bills that I have on an ongoing basis, on a monthly basis that is. But on top of that, longer term into the future, I also want this portfolio to grow over time and overall be a sustainable asset that I can hold on to for years. Now, within the dividend tracker that I just showed you guys with every single position throughout my multiple portfolios, and side note, you can grab that exact same dividend tracker for yourself to help with your investing goals. It's the first link in my description. But just as a side note, this is one of my long-term dividend growth portfolios that are within that larger dividend tracker, and this portfolio specifically earns me around $2,200 on a monthly basis. Now, this portfolio that pays around $26,000 or so per year is currently worth around $500,000. But I do recall that at a point that this portfolio reached around $100,000 in total value, at that exact moment, it felt like this portfolio reached some sort of escape velocity and to a point where this portfolio was able to somewhat sustain itself. Now, what I mean by that is that there's of course different stocks and ETFs within this portfolio that cost various amounts of money. And as the portfolio grew and surpassed $100,000 in value, at that point, the portfolio was paying me maybe collectively $5,000 or $6,000 per year in dividends. And at that point, I was receiving, say, hundreds of dollars on a weekly basis, which was allowing me to use that cash balance without any other outside money to reinvest and buy more shares of different stocks and ETFs. Now, of course, we're all going to have a different way of looking at things, but for me personally, that was the moment where I felt true escape velocity kick in, and I felt the power of compounding take place. When the portfolios were at a point to where the dividends that were being paid to me on, say, a weekly or monthly basis was enough cash balance within each portfolio to, like I said, be able to buy me a whole share or a share or two of different stocks or ETFs within the portfolio. Because at that point, my outside capital, my outside cash infusions into the portfolio, which of course I've done quite a few of over the years, at that point, those cash deposits were sort of not even necessary anymore because the portfolio was sort of self-sustaining itself. So for that reason, I think that once an investor gets to say around $100,000 in total portfolio value, if they have say a 3, 4, 5, 6, 7% overall dividend yield within the portfolio, at that point, the portfolio is going to give off quite a bit of cash flow and allow an investor to reinvest pretty significantly on an ongoing basis. Now, to dig a little bit deeper into what's actually taking place during all this and why this happens, let's talk a little bit about the power of compound interest. So right here on Investopedia, it says compounding multiples money at an accelerated rate. Compound interest is an interest calculated on the initial principal, which also includes all the accumulated interest from previous periods. Generating interest on interest is known as the power of compound interest. So basically what this means is that over time, like I said a second ago, I got paid dividends within my portfolio. Then with that dividend income, with the money, with the cash balance in the portfolio, I then purchased more shares of different dividend paying stocks and ETFs throughout my portfolio. Now at the start, it's going to feel very small because if you have a portfolio currently, let's say of a few $1,000s, you're only going to be getting paid dividends or interest that maybe are $1 or so here and there. But over time, as the portfolio reaches closer and closer to that $100,000 portfolio value, like I said, at least in my opinion, that's when I really felt the power of compounding take place. Now, the actual definition of compound interest: the interest on a loan or deposit calculated based on both the initial principal and the accumulated interest from previous periods. So over time, as you build a portfolio, as you add more money to the portfolio, outside money that is, and of course, as the dividends pay you ongoingly, if you were to use all that money coming in, including the dividends that were paid, to buy more shares of whatever's paying you in the first place, that's what builds out the massive snowball effect that so many dividend growth investors talk about. Now, what better way to show you the power of compound interest than using the dividend calculator and typing in a scenario where an investor, in theory, invests a starting amount of $20,000 into the SHD ETF, which, side note, is my favorite buy and hold ETF. Now, SHD currently has an initial annual dividend yield of around 3.5%. SHD pays a dividend quarterly, and SHD has a dividend growth rate somewhere around 6, 7, 8, 9, 10%. So let's go with 8. Now, just another side note here, if you are looking to build out a portfolio that's going to compound like crazy, choosing investments, choosing stocks or ETFs that also pay more and more in dividends over time is only going to help you really reach that curve on the chart. Now, SHD also has a 3% more or less annual share price appreciation, and with this scenario, we're also going to be contributing $12,000 every year, but I'm also in a second going to show you an example where we aren't contributing anything, and you're still going to see how this works. So first off, before we go through the exact numbers, you can see right here in the chart that if an investor stays investing long enough, even with a relatively small amount of money invested, over a certain time frame, the power of compounding is going to kick in, and the curve is going to start to get more and more aggressive. And to even go back to the title of the video, showing you that after the principal, after the portfolio reaches 100K, the initial portfolio at $20,000 is earning around $700 per year in dividends, but at around year 6 or 7, this portfolio is going to surpass $100,000. And at this point, the portfolio is earning around $5,300 per year in dividends. Now, at this point with the portfolio, like I said a lot earlier, just with the dividend income alone, an investor in theory would be able to buy quite a few shares per year of whatever stock, more or less, that they want to add to the portfolio, which is really going to turbocharge the growth and which is really going to turn on the power of compounding. Now from there, you can see that the numbers just get bigger and bigger, faster and faster, which is also indicated in this chart. You can see that after maybe 7 or 8, 9, 10 years, the portfolio really starts to grow a lot faster. And again, this is all relative, but it just goes to show that if an investor stays invested long enough and just keeps reinvesting, the power of compounding will kick in until the numbers are truly bigger than any numbers we'd ever imagine. Now, if we were to do the same exact example with $20,000 invested and just $1 contribution per year, so basically more or less you're starting with 20K and you're not adding any outside capital to the portfolio, you can see that over time the power of compounding still kicks in. It's going to be much smaller because of course you're not adding any outside money, but as you can see, the same thing is true here. Once the portfolio hits, say, right around $100,000, it really takes off from there and really starts to curve up because the dividends at that point being reinvested are really going to substantially increase the portfolio value and also increase the dividend income ongoingly. So in conclusion, why is the $100,000 portfolio mark so important? Well, it's truly a point in the portfolio where the power of compounding really seems to take off for multiple different reasons. And in my personal portfolio, I definitely felt it. But when it comes to building out a long-term portfolio, I want to hear from you guys down below. At what point did you feel like your portfolio really started to take off? And if you're not at that point yet, what is your goal to get your portfolio to over the next few years? If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.